Our theme today is evolution of U.S. regulation and the standard setting process for financial reporting from the 1930s to the present. It has been a very interesting evolution with many twists and turns, and it has involved periods of conflict and periods of collaboration. We begin with what would be called the period prior to regulation and standard setting in the 19-teens and the 1920s. Early attempts at improving company financial reporting depended on volition by the companies because there was no requirement that they report, even in the states in which they are domiciled. For example, since the 19th century, the corporation laws of the states have been deficient by not requiring companies provide their shareholders with audited annual financial statements, even with annual financial statements without an audit. In the 19-teens and the 1920s, there was a lack of state regulation. Now, the states had securities market regulators, but that applied only to corporations in their states whose shares were traded intrastate, within the state. And it was so easy to circumvent that regulation by arranging for some of your shares to be transacted between states, interstate, and therefore you exempt yourself from the state requirement. Now, there were sources of guidance. Accounting textbook authors back in those days routinely made suggestions and proposals of sound accounting practice. That activity ended about the 1970s. So between the teens and the 60s, it was common for accounting textbook authors to recommend best practice. They disagreed among each other, so there wasn't necessarily a harmony of point of view among the various textbooks. Another source were articles written by leading practitioners in the journals who recommended accounting practice. So there was guidance, but of course companies and their auditors did not have to pay attention to any of that guidance. It was simply out there for your use. There only remained the New York Stock Exchange. Prior to the early 1930s, there was only the New York Stock Exchange to encourage its listed companies to provide fuller financial disclosure, especially in the form of audited financial statements. Now, a stock exchange is not a really good enforcer because if a company does not provide the expected financial reporting, the enforcement typically would be delisting, but delisting harms the shareholders. The stock exchange is there to make a market, and so therefore the stock exchange is not a good source of enforcement of financial reporting requirements. Nonetheless, the New York Stock Exchange had quite a good record from the teens until the late 20s of urging their listed companies to have audited financial statements, that is, to bring an auditor into the picture. And by the end of the 1920s, the large majority of listed companies on the New York Stock Exchange showed an auditor's report, and that was to the credit of the New York Stock Exchange. Now, we take a look at some of the financial reports here that companies began to use. There were some companies that were known for excellent financial reporting back in that period, such as United States Steel Corporation, General Motors, and DuPont. At the other end of the spectrum were companies that provided skeletal disclosure and a number that didn't even provide an income statement. Here we have National Biscuit Company for the year ending 1925. That's Nabisco today. Notice that they begin with plants, real estate, and machinery. A number of companies began with the long-lived assets and then went to the current assets, and they begin with capital stock on what they call the liability side, and then go down to the payables. Accounts payable is right under capital stock. And then you see near the bottom a balance last report. They don't say balance of what, and then they say earnings. That basically is the income statement because this was the company's annual report. One page, no audit, no explanatory notes. And then below that, they show less dividends, preferred, and common. It's kind of a miniature statement of shareholders' equity built into the balance sheet. And so this was the entirety of National Biscuit Company's annual report. for the year ended 1925. Here is Allied Chemical and Dye Corporation, which is today part of Honeywell. Again, a very skeletal balance sheet. We see property up above on the left side, current assets down below. And then on the right side, under liabilities, notice we see reserve for depreciation and obsolescence. It was not uncommon in those days for corporations to show the allowance for depreciation on the right side of the balance sheet, not as a subtraction from the property, plant, and equipment at cost on the asset side of the balance sheet, and there was nobody who said they couldn't do it. Furthermore, you see there is a reserve for insurance. This is a way of smoothing income. So if there were losses incurred as a result of hurricanes or earthquakes or wildfires, normally those losses would be charged to income in the year in which they occurred, and payments would have to be made. On the other hand, if you have what is called self-insurance, which is really no insurance at all, what you do is you set up a self-insurance account, in this case called insurance. You charge it a very large loss before anything has occurred, and once there is a loss occasioned by a hurricane, you don't charge it against the income statement, you charge it against the reserve for self-insurance, which is a good way of smoothing income over the years and not having it volatile as a result of these natural disasters that occur. Sometimes it's called a reserve for contingencies, and we see a reserve for general contingencies, which is once again a smoothing device. Here we have Allied Chemical and Dye's income statement. It begins with gross income after showing depreciation. No revenues whatsoever. They show federal taxes and net income. That is the income statement. At least they showed it. The previous company, National Biscuit Company, showed it as a part of the balance sheet. And then there's a reconciliation of the surplus account, which is kind of like retained earnings and additional paid-in capital. Finally, we have the Procter and Gamble companies, a company that's well known today, with a rather more elaborate balance sheet. But again, on the right side, we show the reserve for depreciation, a very sizable amount, and therefore it is rather unusual by today's lights. On the left side, notice goodwill near the bottom. The goodwill has been written down to $1. This was not unusual back in those days. Many people were suspicious of goodwill and wondered what it was meant. And as I'll mention later, some companies actually wrote up goodwill based on what they thought their goodwill was, internally developed. And so there was a healthy suspicion about goodwill. And so they wrote it off. We'll see that in the income statement at the moment. And it's written down to $1. Why $1? So the company can have a line for goodwill, patents, licenses, and show that they at least have some. And this allows them to have a line showing that they actually do have intangibles. On the next statement, now we see at the very bottom, notice the third from the bottom item on the right. That is the write-off of the intangibles, including the goodwill, patents, and licenses, not written off against net income, but written off against earned surplus, or what we would call today retained earnings. And there were quite a few companies showing even more deficient financial reporting than these three examples. Now, following the stock market crash of October 1929 and the downward spiraling of prices and the onset of the Great Depression in the early 1930s, the stock exchange believed that one of the reasons for the crash was perhaps that shareholders and other investors did not have sufficient reliable financial information on which to make their investment decisions, and perhaps made foolhardy decisions. And so attention turned to try to improve corporate financial reporting, and they approached the American Institute of Accountants, today known as the American Institute of Certified Public Accountants, led in this case by George O. May, the senior partner of Pricewaterhouse, probably the most respected audit firm of the day. And they said, what advice would you give us to improve financial reporting? In particular, they wanted to improve the comparability of financial reporting, because corporations were using any accounting methods they thought were appropriate. They simply decided that if they wanted to record something one way or not to record something at all, or to use different account titles, they could do whatever they liked. And the auditor could not say, you cannot do that, because there was no authoritative source that said you could not do anything. And therefore, there was an enormous diversity of accounting practice. Things were really in disarray at that time. And the New York Stock Exchange and those interested in investor information said, we've got to do something to reduce the degree of diversity of practice. George O. May then chaired a committee made up of the senior partners of the most important audit firms, and they recommended in correspondence with the exchange that listed companies improve their financial reporting, but stopped short of calling for a greater degree of comparability across companies by the use of the same accounting methods. Their recommendation was that each company should put on record, public record, the accounting methods they were using, a list of the accounting methods, and assure readers that they would continue to use those methods consistently in the future. But that did not deal with comparability. There was a reluctance back then, and there's a reluctance now on the part of partners in audit firms to have to try to persuade their clients to stop using accounting methods, even though they had used them for years because they had fallen into disrepute. And companies don't like to be told by their auditor that they should stop using one practice and adopt instead another practice. And back in the 1930s, the audit firms were reluctant to request audit firms, their clients, to drop certain accounting practices. And therefore, there was little desire on the part of the auditing firms to promote comparability among companies. Finally, in 1933-34, regulation came on the scene. As part of President Roosevelt's New Deal program of legislation, Congress enacted two securities acts to regulate the national securities markets, the Securities Act of 1933 and the Securities Exchange Act of 1934. The 34 Act created the Securities and Exchange Commission. We call it the SEC, a federal regulatory agency. This was the first federal or national regulatory agency covering financial reporting anywhere in the world. And so there was really no model or previous experience on which to build. The SEC oversees initial public offerings and periodic reporting to investors in the capital market. Congress had given to the SEC authority to decide upon the form and content of financial statements, and it still has that authority today. In 1935, by the end of 1935, the SEC realized they needed some accounting expertise in matters involving registrants or issuers, companies they were overseeing, where accounting issues were raised. And so they appointed the first chief accountant, a man by the name of Carman G. Blau, whose name appears from time to time in the future, who soon became head of what is now called the Office of the Chief Accountant. And so the most powerful accountant in the world, you could certainly say back then in the United States as regard companies that were subject to the SEC, all of those who were listed on stock exchanges and many others whose shares were traded interstate. Carman Blau became a very important personage. Thus, while the states were unwilling to protect the interests of shareholders by requiring companies to provide them with annual financial reports, the federal government acted to protect the interests of investors in the capital market, and of course, shareholders would see the reports as well. Consequently, financial reporting by many companies at the state level essentially was dictated at the federal level by the Securities and Exchange Commission, which expected to see audited annual financial statements, eventually quarterly financial statements, by all companies subject to their oversight. During the 1930s, Chief Accountant Blau urged the organized accounting profession to, as he said, narrow the areas of difference in accounting practice. that is, promoting comparability, because companies' financial statements filed with the SEC showed a startling diversity of practice, thus impeding investors' efforts to compare companies' financial performance. One official of the New York Stock Exchange complained after reading many financial statements of listed companies that he found as many as 9 different methods of accounting for the issuance of stock options. He says this was unacceptable, and the SEC felt as strongly as the New York Stock Exchange that comparability across companies was indispensable. Because many companies in the 1920s had written up their recorded values of property, plant, and equipment, and had even recognized internally developed goodwill on their balance sheets, which all of the companies proceeded to write down or write off in the early years of the Depression after prices plummeted, the SEC adopted a policy of forbidding the upward valuation of assets as constituting false and misleading information under the Securities Acts. Here we have to talk a bit further about the role of the SEC and specifically the SEC's chief accountant. In the 1930s, and especially then, there was a feeling among the commissioners, including the chairman, and especially the staff, that the upward valuation of property, plant, and equipment was unacceptable because in the 1920s, so many companies had engaged in such a practice based on the flimsiest evidence of the actual valuations, not even asking for appraisals, simply believing that their valuations had gone up. There was a considerable inflation in the 19-teens, and as a result of that inflation, many companies felt that the replacement costs or the valuations of their property, plant, and equipment had gone up considerably. And so they had increased those amounts on the balance sheets. This was considered to be a nightmarish experience, especially since almost all of them were written down to historical cost in the early years of the Depression. And the SEC wanted to ward off any such recurrence of that and took the extreme position that such upward valuations would not be accepted. Well, the first 4 successive chief accountants who lasted from 1935 until 1972, 38 years later, when the last of the 4 retired, all joined the SEC in the 1930s and had a sense of mission. And the mission was, among other things, to beat back any attempts by companies to increase the valuations of their property, plant, and equipment. This was a very strong position adopted by the SEC. Now, the chief accountants back then, the first 4, were all civil servants. They joined the commission, and this was their career. They had very strong ideas. And it was very important that there be a chief accountant because in the history of the commission, there have been so far a small number of chairs who were not lawyers. I would say over 80% of the chairs of the commission over its history have been lawyers, and at least over 80% of the other commissioners have been lawyers. Very few of them knew anything about accounting. Only 3 CPAs have ever been members of the commission. 1 chairman and 1 other commissioner around 1950, and then the third one was 1969 to 72. And so since 1972, there has not been a member of the commission who has been a CPA. Consequently, it has been essential for the members of the commission to rely on the Office of the Chief Accountant in deciding what are the proper accounting practices that should be followed by companies under their supervision. And so the Chief Accountant has played a very important role in exercising that authority, giving speeches and the like. And one thing one has to mention is that not all of the positions of the chief accountant are set forth in writing. Sometimes there are meetings with companies whose accounting has been questioned, and during that meeting, a representative of the commission may say, "We don't think that is sound accounting," and all of a sudden the accounting profession realizes that the commission has made a decision internally that a certain accounting method is unacceptable. And this is not in writing anywhere. So therefore, if one wants to find out what proper accounting practice is, and that was true as much in the 30s as it is today, you have to go beyond what is in writing to find out what has been stated orally. And typically only the technical partners in the very big firms really know, together with the SEC itself, what is the totality of proper recording. Now this is interesting to recite. Slightly over a year in office as chief accountant, in a speech in January 1937, Carmen Blau said in a very frustrating manner, it was in a speech to the New York State Society of CPAs, almost daily, principles that for years I had thought were definitely accepted among members of the profession are violated in a registration statement prepared by some accountant in whom I have high confidence. Indeed, an examination of hundreds of statements filed with our commission almost leads one to the conclusion that aside from the simple rules of double-entry bookkeeping, there are very few principles of accounting upon which the accountants of this country are in agreement. This was one of the reasons why Blau and others were trying to persuade companies and their auditors to move toward more comparable accounting methods, but there was continual resistance. Because it was clear to Carmen Blau that by the latter 1930s, the accounting profession was not narrowing the areas of difference, it certainly took no initiatives to do so, he made it known that the SEC would begin doing so itself if the organized profession were not to take the active lead. And as a matter of fact, in 1937, the Commission issued the first of its long series of accounting series releases that dealt with accounting, which said certain accounting methods were unacceptable, and this was the Commission decision. Well, there's one issue on which the accounting profession was united, and that was that its accounting standards should not be set by government. And that prompted the American Institute of Accountants to authorize its Committee on Accounting Procedure, the CAP, to begin issuing bulletins to recommend improved accounting practice. And so this was really at the behest of the Securities and Exchange Commission that the American Institute of Accountants finally decided to provide formal guidance on best practice. Now, there are certain terms that are important in this discussion, both set around 1939. The SEC made it clear in an accounting series release, number 4, which is still in effect today, that bad accounting is not remedied by disclosure. Accounting has to be acceptable, and you cannot justify bad accounting by sufficient disclosure. And the SEC made it known that it was looking to substantial authoritative support as a basis for deciding what is best practice. The SEC has never really had a taste for setting accounting standards itself. It had congressional authority to do so, but it didn't have the staff or the expertise or the desire to do so. The chief accountants have always wanted accounting standards to be set in the private sector, even though the private sector was overseen frequently very tightly by the public sector, that is, the Securities and Exchange Commission. And so it said it was looking for substantial authoritative support. It's never defined that term. It essentially means not just one company following a practice, or even two companies following a practice. We want a support from an authoritative source that has sufficient standing to be respected by the SEC. In effect, they were suggesting that if the American Institute of Accountants were to authorize a committee made up of many respected practitioners around the country to recommend best practice, the SEC would respect those recommendations. That doesn't mean they would not necessarily dissent from them if they disagreed, but they would certainly take them seriously. Another term that came into use was generally accepted accounting principles, GAAP as we call it, and I'll refer to GAAP later on. It was a term that came into use in the late 1930s. It says generally accepted because if it's accepted by one or two companies, a method doesn't necessarily mean it's a proper method. It should be generally accepted by companies, and the term is used accepted, and we still use accepted, though we mean acceptable today, because by and large it was looking at how many companies were following a particular practice. And if enough respected companies were, then they would say, therefore, perhaps it is one that should be considered part of sound accounting. So these terms, GAAP, generally accepted accounting principles, and substantial authoritative support continue to recur today. And they are terms of art. They are meaningful terms. GAAP essentially means accepted practice, practice that the SEC is willing to say may be used in financial statements filed with the Commission. Now, in 1938, the SEC made it known, as I say in an accounting series release, that it would respect accounting principles so long as they have substantial authoritative support. And as I say, this sent a message to the accounting profession that it must organize itself to provide collective guidance from an authoritative body, else the SEC would itself set the standards. And George O'May, who was the intellectual leader of the accounting profession in the 30s and the 40s, chaired the committee. And in 1939, the committee began issuing a series of numbered accounting research bulletins, a total of which of 51 were issued by 1959 when it was superseded. And finally, we come to the 40s and the late 30s, but the 40s. The Institute's Committee on Accounting Procedure began its work in 1939 and was composed of 17 partners in large and middle-sized audit firms, plus 3 accounting academics, having a very slender support staff, which began to be headed in 1944 by former SEC Chief Accountant Blau. Blau had stepped down as Chief Accountant in 1938, and after military service in 1944, joined the American Institute of Accountants as the full-time research director servicing the Committee on Accounting Procedure, and became a very important source of GAAP during the 40s and the 1950s. Also, in 1940, the American Accounting Association, the organization led by accounting academics, published an important monograph, An Introduction to Corporate Accounting Standards, by the 2 most respected academics in the country that day in accounting, Professors William Payton and A.C. Littleton at the University of Michigan and University of Illinois, respectively, which advocated the use of historical cost in the body of the company financial statements. This was an elegant rationalization of historical cost practice, and being historical cost, it was consistent with the position already taken by the Securities and Exchange Commission, and has become one of the most influential monographs ever published in our field. It's still in print today, and it's still used in classrooms, and is, as I say, an elegant rationalization of historical cost accounting.